Sweet. Hey everyone, thanks for joining us after lunch. I hope we're all full, ready to go. I'm going to talk about investment. So my name's Jeff. I just wrapped up my time in residence. I did a year in African studies, also did my MBA. My research focus was on the digital economy in Nigeria. Currently working as a product and growth lead at MASH. We're a startup where we're looking to remonetize the internet, find better ways to align incentives between publishers and their users. Joined here with Remus, Linda, and Paul. I'll give them some time in a second to introduce themselves, and we're going to speak about investment, think about how we can incorporate impact or think through an impact lens in our investments. So why don't we go ahead, we'll go down this way, start with you, Remus, maybe your name, what you're currently working on, and we're here to talk about investments. If you have a favorite investment or one you're particularly proud of that you want to share with the audience.
Okay, 3 in 1. Hi everyone, great to be here. I'm Remus. I currently run the venture strategy team at Wayra. Wayra is the open innovation and corporate venture capital arm of a multinational telecom company called Telefonica, more known in the UK as Virgin Media O2. My favorite investment, and I told you it's a hard one. Usually you answer with my next one. But I'm trying to get a problem that is very common to most of us. So it's either the one around rooming. So when you travel to a foreign country where the rooming costs are exorbitant, we invested in a company called Airelo that is a marketplace of eSIMs. So when you travel, you buy local connectivity. So we're kind of done with all of those political nightmares between countries and roaming payments. I will stop here. I have more big societal problems that we can solve even through a corporate lens.
Thanks.
Thank you.
Hello, my name is Linda, and I've done many things throughout my career, but most recently and most proudly, I'm the faculty member at Equitech Futures, teaching entrepreneurship. So Equitech is a digital campus. You've heard some of our folks. I'm happy to talk more about it, but we really focus in training and talent development in AI and data science, and really globally minded. So really, what is this talent and development in areas, 48 different countries throughout the world. And so I weave in entrepreneurship education into all of our existing programs. But the thing I'm really excited about and that we're building now is a venture studio. So we have a great talent network, and every investor knows that that's the thing you really want early on. There are a million different ideas, but the talent, the founders are the people you want to invest in first. So we have that network, and building out the infrastructure to support innovation and entrepreneurship at Equitech. And investment, I'm going to answer a sort of broad, like a category of investment. Mm-hmm. I want to devote my time, energy, and money into climate-related solutions. I think that's the most pressing problem, and I think it is cross-industry, so a good, diverse portfolio.
Hello, everybody. My name is Paul Miller. I help run Bethnal Green Ventures. We're an early-stage tech-for-good venture capital firm based in London. We've been going for about 10 years. We invest in basically prototype stage ventures, so 2 or 3 people and a piece of tech that addresses either a sustainable planet, an inclusive society, or healthy lives. And we've invested in about 170-odd companies over the last 10 years. And yeah, it's great fun, to be honest. Favorite investment? Oh, we don't have favorites. But I'll just give you an example of one of our investments. One of the first ones we made was a company called Fairphone, who produced the world's most ethical and sustainable smartphone handset. When they came to us, I think everybody thought, well, I thought they were mad. They came to us saying, we want to start a new consumer electronics business with your £15,000, which was what we invested at that point. But it turns out they were right, I was wrong. Now turning over millions and millions of pounds, and we know that they've had a real impact on the whole consumer electronics industry in terms of bringing awareness to human rights issues and circular economy issues in that industry. So yeah, that's just one of the companies that we've been involved in.
Awesome. Thank you. Thanks for the introductions. And I guess just for the audience, if you have any questions, I'm going to ask a couple of questions to really keep it conversational. So if you have anything, I'll pause and take questions from the audience as we go, not save it for the end. So feel free to put your hand up if there's ever anything you want to jump in. I guess the first thing maybe you can kick us off, Paul. Since I've come of age in my life, living a low interest rate environment, so interest rates are the highest they've been. there's a lot of like inflationary pressures, like valuations are falling. It's difficult for people to raise their next round of funding. As a, I guess, more traditional VC on this panel, what does this like global macro environment mean for you and for your investments?
Yeah, so good question. I mean, it's definitely, there've been blips along the way that whilst I've been investing, but this feels like the most serious in terms of sort of challenge to the whole early stage investing industry. To be honest, though, actually, it's a bigger challenge to growth stage investors at the moment. Anyway, they're the ones who've really taken the hit, as it were. We haven't lost any money yet. I think I would say that there are two corollaries to that. One is that impact investment has held up better than pretty much everything else. So actually, it looks like institutional investors, individuals, and so on, when they're sort of thinking, okay, right, this is the risky bit. The risky bit they're still willing to do is impact. That might change, but at the moment, it looks like that's true. The other piece is that Europe seems to be doing better than the US. You know, there is certainly evidence that this year Europe has overtaken the US in terms of the amount of money being invested into impact tech. Again, it might change, but so I think that there's a shakeout happening. There's lots of things changing. I wouldn't say it's all bad though. That would be my take on it.
Absolutely. And Remus, how do you think about this? Like being backed by a corporate, like how does your thinking, your investment strategy shift in these economies?
Actually, it hasn't shifted much in terms of strategy and the way we were investing before. To give you some context, 80% of our investments are linked strategically to the corporate, so it depends on their strategy, depends on the integration you do with that startup, and 20% are tech bets that we think, even though today, like the eSIM space, we invested during the pandemic where Apple didn't even launch the SIM-less phone. So there are strategic future-proof ones that we were doing. Now, I think the challenge that the market dynamic brought to us wasn't directly to us, but to our corporates. So you could see lots of corporates restructuring. You could see lots of corporates making lots of redundancies out there, including the hyperscalers of Microsoft, Meta, etc. And that's impacting the way we operate with startups to make them land strategic opportunities with corporates. And of course, you may say, yeah, if there's a restructuring opportunity, there's opportunity for startups to be plugged in. Yes, but let's not forget, these organizations, these corporates who are designed to run business models at scale and maintain the risk as low as possible and be as steady as possible, you know, in a situation of crisis, their aversion to risk changes significantly on the downside, unfortunately, which makes them way more resistant to open innovation and bringing innovation on board. So to tell you the truth today, I have capital to deploy and I have 1.5 months to deliver it. And I still have, I mean, honestly, and if you have a Series A startup linked to a telco world, I'm here to listen. And it's frustrating on our side because we know sometimes how hard it is to fight to bring companies in when you have a realm of opportunities. And now, especially at this point of Series A and what Paul was saying, Europe indeed is still there, but we see more seed companies now because out of crisis you see the outliers coming up and there's people backing them. You would see growth stage being affected, but the companies crossing the chasm, those at Series A, there are less and less deals in the market, and we have more money than we budgeted to spend this year. It's incredible.
Yeah, any founders in the room, this is the guy to talk to after the call. Yeah. But I guess on that note, like Linda, to follow up, like you're in the venture building space, and especially like this early stage. Like, how are you think about this? Like, we know, like, when the economy is down bad, like, people are going to universities more, people are starting companies more. What have you seen?
Yeah, I think from the founder perspective, like, yes to both of these things. There's a lot of seed, there's a decent amount of angel, and that's great. And there is that funding gap. And I think, you know, if we zoom out a bit, there is some market correction that I think is necessary. You know, you talked about the drop in high valuations, and that's true. And I think it's needed. I think we should not be living in a world in which we expect, any company that is B2B SaaS isn't generating revenue is going to be valued at multiple billions of dollars. I think we don't have a strong enough business case for that. When I talk to founders investors, in this environment, I think, one of the pieces of advice or guidance is to look at how you can start generating revenue. On one hand, that sounds so basic to say, you're a business, think about where your cash flow is coming from. But we've been operating in a long time. I come from Silicon Valley. There's this very dominant belief that seeps out of Silicon Valley that says, just go for users at all costs, worry about cash later. And that worked for a bit. But we're seeing that doesn't work anymore. Investors got scared. You get these super high valuations. They're not showing actual cash. They're not showing long user retentions, and the business model is being questioned. So I think if you're a founder, start thinking about how you can generate some of your own money and not rely strictly on outside investment.
100%. Going deeper on that, Paul, you mentioned that investment, or impact investing space, people are still leaning into it. I think having founder alignment with the mission of what they're doing, not just growth at all costs, trying to find something that can grow and you can keep raising that VC, probably plays into this. You touched on alternatives and funding. So we have a corporate VC here, you're a venture builder, building venture studio, more traditional VC. For somebody who wants to start their idea, somebody has something that they really care about, what are the options that you could think about? What's the benefit, I guess, of each of the investment options you offer?
Right, big question. I think so. There are lots of options, which is a good thing because we want lots of different sorts of businesses. So it is way healthier now than it was 10 years ago. From a point of view, if you're somebody who understands a particular social or environmental problem, a customer problem, and you're like, I want to build a business that solves that problem. You can look at the landscape. There's people you can talk to find the right fit for you, and I don't think there is one answer to what that should be. And I certainly don't think that venture capital is the answer to everybody's problems. And so, in many ways, it's a much healthier environment, much healthier ecosystem for tech for good, impact, whatever you want to call it. And and that's a great thing. And those range from the hyperscaling sort of side of things still exists, but it's just much more selective, through to just generate revenues from day one, through and then there's angels, there's accelerators, there's incubators, there's studios. There's all these different models that you can pick and choose from based on what you're missing or what you feel you need as a founder, and that's great. That's really good.
Absolutely. Maybe take a pause here if there's any questions from the audience. People want to jump in, or any follow-ups, anything that's been said so far. Otherwise, we'll keep going up here. But again, feel free if you have any questions, put your hands. Yeah, absolutely, got one up here.
Hi, I'm Gila from the World Food Program in Accelerator. I wanted to ask, I'm from the acceleration side of the world of startups, and we give grants.
Yep.
There's no UN agency today that can do equity, but hopefully maybe we'll be the first one in the future. But my question is, especially for you, Paul, have you seen startups that receive grants from different actors, whether it's governments, UN agencies, other actor foundations? What's your advice to them to become more investable, let's say, if you have any advice?
So investors usually love grants, because it's non-dilutive finance, and so we certainly work very closely with Innovate UK in the UK, for example, who are big government-funded grant maker, and I think early stage investors particularly, we love working alongside grant makers, and a lot of our portfolio, I'd say probably 50% of the portfolio get grants in one way or another, either from public sector or from trusts, foundations, and so on, because they're solving problems and that's often the mindset of grant makers, is to solve a problem. And so startups that can come to them and say, look, we think we've got a solution to that problem. What the risk of it, from a startup's perspective, is that you change what you're doing to meet the criteria of the grant. And so I'm quite harsh on our startups. Really, do you really want to do the grant, or do you want the money? Do you know what I mean? It's that kind of question. So I think that's the tension you have with grants and startups: is does it change what you're doing in order to meet the criteria of the grant? And I would definitely say don't do that. But it's hard, and that's a difficult decision for some startups.
One thing I see with grants, if I may jump on that, besides everything what Paul said, is the operational burden you're taking on board to do all of that reporting, which it's a bit more stiff and rigid than the VC reporting. So that's some time you're putting in as a founder.
Again, I could say it's better now than it used to be, though, because
Yeah,
if you think
it
used to be that you had to do like a written report for the grant and stuff, and now most grant-making bodies have online reporting, and it's not. Yeah, it's still bad, but it's not as bad.
It takes time, right?
Yeah.
Consider that, have that in mind when you're taking.
What I love about what you said, though, is that as much as founders are looking for money, you're also choosing your investor. I think it can feel very much that power dynamic is like, please give me money, but there's also the choice in saying like, is this the right investor for me and what I need and what I want? And from the investor side, I think that's much more clear. Of course, you're choosing founders that you believe in, that you want to work with. But I think my reminder to founders is like, choose wisely. These people should help you, but you're also going to be working with them for a long time.
Absolutely. I guess in your current role, working with a lot of founders, like one-on-one, starting from zero. What is it? Like, I guess, Paul, you mentioned tech for good. We talked about impact, and sometimes it's like ambiguous, ethereal type of term that people use. But like, how would you define impact with the work that you do at Equitech? I would love to hear everybody's take on how they define, how they look for it, how they select for impact in their investments.
Oh, I love that question. What is impact? Because it's a very popular, fun word because it can be ambiguous and defined in any way you want. But I think how I define it and how we look at it as Equitech is we are investing in talent, and so it is people. It is the students. It is the alumni. We have some, many of them here, and I think that is one much more tangible and measurable in that you can follow those people. That's the unit of measurement. What do these students do? What kind of, businesses do they create? We can see these, first, second, third order effects. And so that's the impact that I look at. It's like, what is that human transformation? And then what are the ideas and work that comes forth from that?
Amazing. Remus, Paul?
Paul first.
So for us,
On the dark side.
Impact or positive impact has to be intentional and measurable. Those are the two key words. They come from there's a definition of impact investing that's from the Global Impact Investing Network, and it's sort of paragraph definition. But those are the two words that you really need to tick off for something to be an impact investment. The intentional comes to the founders. It's like, why are they doing it? What's their motivation for doing it? Understanding like those founders and why are they trying to solve this problem? Why do they care about it? And then can you scale that through to a company? So can you build that into the culture of the company beyond? And that's often now like the sort of mission-driven businesses, that sort of language, purpose-driven. And then the measurable piece is, can you measure the impact that the company has over time? For us, like, it doesn't need to be complex. It's usually just choosing some simple metrics that let you know, has this company done what it said it was going to do? And for us, we try to link that impact to the business model. So the more of the product or service they sell, the more positive impact they have. And we're lucky that we work with them from pretty much day one, so we can help them set those things up. That's our definition of impact investing.
Absolutely. And Remus?
On our case, jump on it.
This lady wanted to ask a question.
Okay.
Sure. Thank you very much. Thank you very much. Can we use the mic for our online?
Thank you. Thank you very much for your talk. This might be a very naive question from someone who hasn't had any contact to investment before, but do you have any practical advice how to navigate through this network of investment and you said you can actually also kind of choose your investor, but how to find the right ones and where can you share the aims and the goals?
The rumble from the crowd.
Maybe what we'll do is we'll take a couple questions. I think we had two in the back. We'll take both questions. You can respond to them as we want. There's another question back there, I believe.
Do we respond to this one or finish the impact one?
We'll move on from impact. We'll come back to that one. Yeah.
Sorry, I'm also not really in the field of investment, but from a perspective of also what the last panel was talking about, sustainable development goals, and saying that grassroots projects are quite important in terms of people are solving their own problems, and then these are kind of the startups that we need to solve problems that governments ideally want to solve as well, but maybe they don't have the knowledge or the ability, because we need people on the ground. And then in terms of investment and venture capital as a capitalist, do you think that VC is plugging a gap because the government doesn't have I don't want to say the ability, but like there's only so much funding, and or do you think there's kind of a way to bridge it so that government can work with the private sector to kind of move forward towards sustainable development rather than acting in such a siloed way? I'm not sure if I explained that very well, but
I think I'm getting those perfect. I think.
I want to take that one first, and I first want to say thank you to both of you for asking those questions, because both of you introduced that question, and I'm going to call out gender here, as women saying, I don't know if this isn't my wheelhouse. And I think, I'm the only woman on this panel. For a long time, I felt like I'm not an investor. I don't know what this is. And I think that's actually what we need. We need more people who come from the outside, who have this broader perspective. I think it can feel very much like a world with a lot of money and a lot of influence. It feels very closed. Venture capital, it's really a closed circle. But I think what we need and what the world needs is to open up what investment looks like. And some of that is venture capital. And there's other modes of investment. We've heard some things here. We've heard some grants. Government, absolutely. I think we need other sources of capital in institutions that are interested in both financial, but these impact returns. So I want to see more investor education. I want to see more pathways for people to be able to invest. People say, these are issues I really care about. These are ideas that I'm really interested or have expertise in. And here's how this capital could be allocated to improve, outcomes for everyone.
Absolutely, yeah, and I think like the other half of the question was thinking about the role that VC plays, like how governments, like Hila had a question with like the accelerator from the UN, and so it's like, well, how do you, building upon that, what's the interaction, what's needed in this space to make it more accessible for people to break into the space, like being able to navigate, understanding what their funding options are. What would you like to see more in your industry?
Yeah, absolutely. I think so. The investment landscape is very big, it's very complex, and it's very hard to get into. And it's up to all of us to try and make that better. To be honest, we're opening up for applications for new investments a week on Monday, and so we've started quite a few people have, I think, found out about this in one way or another, and have started sort of contacting us for investment the last few weeks. And we always ask this question: oh, how did you hear about BGV? This time, so many people have said ChatGPT. Oh. So they're asking ChatGPT, where should I go for investment? And I think that's just it's really interesting. And ChatGPT is actually quite good. I was like, whoa, hang on, I'll try that. And so I went and sort of started trying to, ask ChatGPT questions. I sort of pretended I had a startup about this and said, who should I approach? The answers weren't bad. It was pretty good, because actually the investment world, although it's very disjointed, there's lots of information actually out there on the web. So ChatGPT, in terms of training the algorithm, has obviously picked all this up, and so actually it's quite a good aggregator of information about investors, it turns out. So I think there might be a bit of a change happens over the next couple of years in terms of how people are able to navigate the investment world based on LLMs and AI. So that was that piece. And just on the government piece, so actually in Europe, I don't think this is quite true in the US, but in Europe, the largest investor in venture capital is government. Yeah. So the largest investor by quite a long way, actually, in the UK into the venture capital firms in this country, particularly the early stage ones, is the British Business Bank, which is owned by the government. And this is sort of off the record, I guess, but the British Business Bank, I think they would admit this, 5 years ago, wouldn't have done impact investing. But they were just like, oh, we don't do impact. We're all about supporting SMEs and sort of just economic indicators. Now, very much into impact. There's been a real shift, I think, in the way the British Business Bank, and actually the European Investment Fund, which is the biggest LP into sort of the wider European venture capital, they were pioneers of like impact investing, to be honest. They were thinking about it like 10 years ago. They had a special program about how do you measure impact. They created this thing called impact carry, which is the idea of how do you link the incentives around impact and so on. So actually, and that's a government-owned institution. So government has played a big role, actually, I think, in developing venture capital towards like impact investing. And we shouldn't, they don't shout about it, but actually behind the scenes that government is very involved in the venture capital scene.
I think governments play a big role. There's role for it. Also, corporates play a big role. And it's like curious, Remus, if you could share a little bit, and I'll open up the question as well if anything they want to add. But just like, how do you balance between like financial returns and expectations? I think it's different for each of our panelists here. What the incentives are, but how do you balance the incentives for your corporate and also like financial returns, but then also these impact metrics? How do you think about that as a corporate VC? And if you guys have an answer, would love if you could chip in as well.
So for us, it's a very simple formula. We have a KPI that's twice as important than the return of investment KPIs, which is called FIT. We call it just FIT. Which means the total amount of contracts and value of those contracts between the startups that we work with and invest in and our corporate. And that could be happening in various ways. Either the corporate buys the technology and deploys it internally. The corporate could resell through their channels and complement their product portfolio with certain startups. Even a deal I did this year, it's quite interesting. We used a startup to go to market through it and sell our connectivity products. It's a one-stop shop moving platform for moving houses. So it's incredible the amount of models you have. So for us, it's very important to have that impact in the P&L of the corporate, because I come from a world, and you were mentioning accelerator. I used to run a couple for Waira when we were doing even 9 at the same time, and we even had one in poverty premium and try to create that impact out there. But for a corporate perspective, the metrics that we could have shown success is what we call in the startup world vanity metrics. Because, yeah, look how many startups we impacted, look how many startups we helped fundraise, coaches, the community, the ecosystem, PR play, whatever you want to name it. So recently, in the last 3-4 years, when we changed our model, if you compare in the past that we were super excited when we had the 50, 100K proof of concept with that startup, but nothing happened with them down the line, which was painful for us, because you know what, in the accelerators, you invest at the beginning of the program. So down the line, if the corporate doesn't see a fit, and they usually don't with pre-product market fit startups, it's very hard to integrate them, then you remain with that startup in your portfolio, and you're trying to help them with other ways, but in the end, the strategic fit doesn't exist. So then down the line now, when you do deals worth 10 million, 7 million, you feel better about this impact. Like on one side, you produce revenue for that startup. On the other side, you showed P&L impact for the corporate, so they could still fund these deals and open up and see, okay, this is possible, working with such a small company to produce impact. So for us, this is where we measure impact, maybe not in the more bold improvement ways that my peers do here, but we still try to make consumers' lives better.
That makes a lot of sense, and I guess. And Linda, how do you balance this trade-off? How do you think about, like, surely if you offer the product for free, that's probably the best case scenario, but then it's like that wouldn't really be much of a business. So how do you balance that? How do you walk that line?
Yeah. It's always trade-offs. And it's something actually that you mentioned that I think a lot about is the time span, the longevity. And yes, I want to avoid all vanity metrics. You know, you could get up there and say, we've invested in X amount of startups, we have this many users, this much valuation. That matters a lot less to me, or I'm much more interested in, like, what does that performance look like in 3 years, in 5 years? We know the life cycle of a startup. You know, lots of them will die. And you know, I think I'm more interested, you know, success to me is were we able to make the right bets on the right people and the right ideas, such that in 5 years They are still in operation. They're scaling. They've been able to navigate change. We know markets change really quickly. Have they been able to navigate those changes ahead of time? And I think, at a portfolio level, looking at impact from a sustainable point. We're not interested in unicorn hunting. We're not interested in, only investing in hockey stick growth. I'm much more interested in, do we have enough that we can, our individual companies can continue to operate and grow? And at a portfolio, can we continue to invest in more ideas and entrepreneurs that we believe could really make our world a better place?
Incredible. And Paul, I guess a more traditional VC on the panel.
Well, I slightly disagree with the idea that impact and profit or return are a trade-off. I certainly don't think of them as a spectrum. I quite often describe it as, it's a Venn diagram. You've got like highly profitable companies and highly impactful companies, and there is an overlap. There are companies that are both, and that's the bit we're interested in.
Yeah.
And quite often we talk, and I've seen this time and time again actually, is that we back a small startup, they grow, and often they're like the first entrant into a market, and then that market gets more and more competitive, and essentially their impact becomes their source of competitive advantage, because they're able to demonstrate that they are the most impactful of that group of companies, and it builds a moat around them. It makes, so we often talk about impact as a source of value. Like the impact, the way that you demonstrate your impact can be a real great defensive moat and keep your company being like more valuable than your competitors. So yeah, I don't think it's always a trade-off. I think it can be used as a tool very positively in a business strategy sense.
Absolutely. I guess that's that intentionality that you talk about of impact. I think we have two questions at the front here. If I
may go as holding the microphone.
Perfect.
I'm in power right here.
Cool.
Well, let me ask. We've been heavily discussing about the life cycle of startups. However, we are well aware of the fact that we are facing a massive climate tech investment gap. So apart from the fact that software solutions are one part of the puzzle piece, we are also in desperate need of overcoming the funding gap, leading towards making sure that we invest heavily also in the climate tech hardware solutions. So my question goes to the innovation regarding venture capital firms and their fund structures in itself. So we're well aware of the fact the typical classic VC fund structure has a fund time of 10 years, 5 years investment, 5 years holding period before you then come to a point where the LP is also expecting some returns. And then after those 10 years, you're measured against those money on investment capital that you need to show, prove that you have the ability to be successful fundraiser in a way. My question goes back, apart from Sequoia having set up this Evergreen Fund a couple of years ago, we have not seen any other innovative solutions towards overcoming this misalignment of incentives between facing hardware tech solutions, which might need more than 10 years time against the investment or this inherent expectation by the VC firms to get back the money after a certain period of time. What's your take on it? Can you elaborate on what are other innovative solutions apart from the Evergreen model, or shall we give it a try for those Evergreen models on a way larger scale?
Yeah, you're absolutely right. There is this tension. I think so. The Evergreen model hasn't really taken off in terms of lots of other people copying it, and the main reason for that is the demands of LPs or limited partners, which so pension funds, like all the big institutional finance that is often behind venture capital. They essentially require fixed time frames because they have to estimate like when they're going to have returns in order to pay their liabilities to their members. So there is a structural reason why it's difficult to break out of that 10-year fund cycle. What I think we're seeing, though, is everybody recognises it, but is that the industry is adapting. So you're seeing a lot more, and this, we're starting to get a bit technical, so sorry, but a lot more things like secondaries. So the idea that the 10-year funds that are actually investing in early stage businesses have more certainty that they'll be able to sell their shares to somebody else who might also have a 10-year fund, but their 10-year fund is, let's say, starts 8 years left after the first one. So you end up then with an 18-year fund, effectively. But it's got 2 different parts to it. And that's becoming much, much more common. So when I started investing, you didn't really hear about secondaries. They were something that happened only in private equity, not in venture capital. Now they're very, very common. So the industry is adapting a bit to create longer timescales, I think, especially at the moment where there's no IPO window, where you can't like really list. So you're seeing more and more secondaries funds. So that's one adaptation that the industry is taking. The other one is balance sheet investing. So corporates getting more involved because they don't have the time frame. So, for example, Fairphone, who I mentioned earlier, we actually sold most of our shares in Fairphone earlier this year in a dip in the market, basically, but to a coalition of investors that was led by ABN AMRO, who are doing that as a balance sheet investment. They're building up an impact portfolio as a balance sheet investment, and that sort of adaptation in the industry, that wasn't happening 10 years ago. Now it's starting to happen. So I think that the timeframes are getting longer, but not through fundamentally reinventing the idea of the fund structure. Sorry, bit of a esoteric kind of.
Definitely. For our audience in the room, what is a balance sheet investment? How does that differ from, I guess, a fund investment? Or how are you thinking?
It's your own money.
Yeah. So basically, we get allocated corporate money from their balance sheet to invest every year.
Yep.
So my investment budget renews every year. Hence why I was asking you kindly if you know a deal. Why would we leave it on the table, right? So yeah, and then we don't have the pressure to return in 10 years in whatever the structure requires, right? And that's magical about it, and that's why I'm not moving to a traditional fund yet, because it's so much more pleasure for me personally in this space. You have the time to work with the founders, you have the time to plug them into the corporate, and then the best of the best, you can get on nearly every deal because you come with strategic, with operational experience, you really add value, and then the VCs out there, if money is the only differentiator, they find it hard to jump on good deals in the end and partner up with the right founders. And that FOMO doesn't get me, for instance. Like, I'm always very comfortable. I know I can join a convertible note down the line. I don't have to squeeze my company into this round. So it's way more comfortable, to be very honest with you. I mean, sometimes I feel bad about my VC peers when they're fighting over a deal, convincing a founder. In the end, let's do co-lead on this round just because we both like this company. There are many other companies like this in the market. I don't have those discussions. So yeah, I feel good about that. Having a balance sheet investor, it's a different play, honestly.
Yeah, but I think you highlighted something really important, which is these different incentives. And classic VC is really good at software. It's really good at B2B. It's really good at, because of the economics. Hardware tech fundamentally is not going to scale that way. It has scaling costs. And so I think we need other alternatives. So I think some of the wishes, yes, you might have different fund structures, but I think that's a place I want to see governments play more. I used to work in universities. You have all these research labs who also have money, and they tend to have a little bit more patience. So if we want things in climate tech, if we want something that we know has a long R&D cycle, we need investors who have that patience and that capital. And I think it's not going to come from classic VC.
And I think just to close on the hardware side, I enjoy looking at hardware deals. I mean, I've been around people who build software and been around people who build hardware. I feel it's so much different, and the velocity of building iterations, it's so much harder than in software. So I think a solution would be corporate venture capital, because in that sense, if you look at all of that supply chain across a certain vertical, and you're trying to get all of those strategic partners to produce the components or have the access to market, they should be incentivized or open their minds to understand that if they get first on that train and put their bets, which it's small for a corporate, right, to support 20 startups in that field, 1, 2, 3, hopefully as many as possible, will define a new category that they will be joining at the beginning of that journey. So it's so crucial for corporates to understand that on the hardware side.
Absolutely. We got 2 questions at the front here, and then we'll get to the question at the back after. Go for it.
Thank you for your presentations. I'm Madhu. I'm a Rhodes Scholar and been a career investment banker. So words like responsibility, impact, and ethics kind of make me blush. But nonetheless, I'm actually in entrepreneurship mode, and I'm starting up my own AI advisory practice. But one of the things that I've seen in my career in investment banking is, and even in my sort of current entrepreneurship mode, I hear a lot about people telling me, well, lots of failures, this, that, and the other. But one of the things I've seen in my long career in banking is we kind of know how to deal with failures because they kind of deal with themselves. The bigger issue that we have is dealing with our successes. When things are making money, we leave them alone, right? We don't ask questions, right? We kind of just let it grow, let it be cool. Now, in the context of impact investing, a lot of the narrative is very linear, and we're in a non-linear world. So I guess my question for you guys as investors, and also the people from the UN and others who spoke earlier, is during sort of this life cycle of impact and investment and whatnot, how do you deal with stuff that's actually going right? Do you guys really have the guts to ask the question? Because you invest in something at seed stage, it becomes some sort of subscriber gobbling success, okay? And I'll give you one sort of clear example is, with say Facebook. I don't think they sat down in a room whenever it was 10 years ago thinking, hey, one day we'll create mental health issues, They went to sharing photographs and whatnot, which we've all used, and here we are. So at some point, that sort of impact has become very non-linear. And I guess my question is, eventually, as an impact investor or in this whole impact investing narrative, at what point are people actually really asking the questions of the successes and whether people are willing to U-turn, whether you actually turn up to the CEO who's now become a CEO from some venture kid, and who is probably walking on water, and sort of say, well, actually, you know what, this is going in a direction we don't like.
Thank you for that question.
We don't ask those questions in banking.
Yeah.
Can we clap for a question?
Anybody want to jump in with that?
Yeah,
it's a big question, so
Yeah.
maybe we should do it. So I think you're absolutely right. I would say my experience of the impact investing world, though, is that there is a really big focus on responsible leadership. So almost every impact investor I know, they will have some way of assessing founders or management teams coming in and so on, around not just like their financial or sort of business track record, but like them as a person. For us at BGV, it's a lot about, because we're often working with first-time founders. They're people who have not run a business before. And it's about building the resources, the mentoring, the networks, the community around them so as they can learn responsible leadership, if you like. And I think that community also acts as a source of accountability, because if they have a peer group, in our case of like we fund about 20 startups a year, so you've got 20 CEOs a year, they all get to know each other, they all talk to each other about the issues of becoming a CEO. They've got that like peer accountability as well, and I think that's really important. The other thing that we've done is we work with all of our teams to go through a process regularly of thinking about the unintended consequences of your business. So we have an exercise that we take everybody through when we first invest, but then we know that we ask them what was the outcome of this exercise once a year, but we know they do it more often than that. And it's just, if you're constantly thinking what are the unintended consequences or possible unintended consequences of our business, you're just much more likely to address them early and so on. So there are cases, obviously, of like, if I often think about Theranos. Like, would Theranos set out to be a kind of tech for good business? They were trying to revolutionize healthcare. would we have invested in Theranos if they walked through it? Now, I don't know. Right, but I want us to like constantly be thinking about our systems, our processes, to be able to know that, like, to have more and more confidence that we would spot, like, essentially an impact fraud, because there will be more of those, and we need to be on top of it. So it's something we think about a lot. I'm not sure we got a perfect answer, but yeah, you're absolutely right that it's a live issue in the impact investing world.
And I think it's about prevention. Prevention is the best thing, and I mostly work with very early stage. So, I haven't gotten to the, Facebook, what do we happen now? But, as an investor, yes, you're investing capital, but you're also investing your time and your leadership and your guidance, and your soul. And I think that comes with the responsibility, and I've had some of those conversations with early stage entrepreneurs. I've been in situations advising early stage founders who say, ooh, we want to operate our business in this particular area of the world where we know labor is really cheap. We can afford to pay people virtually nothing, US dollars, just a few US dollars an hour. And I've had the conversations to say we could, and we won't. Because what we said we wanted to do is provide, jobs with dignity. There are other values at play here that are integral to the business model, not just the mission statement and values, which are really lovely things, that we should all write and remind ourselves of, but also integral to the business. And so I think it is that as an investor, asking lots of those questions and asking them early.
Yeah, for me, just to add something more than my colleagues just said, I focus more on the mental health side, because I've been a founder 8 times and I know how hard it is. Being a founder is very lonely, and you need to hustle a lot. You need to spend less time with your family, with your friends, and especially when you're at the success that people perceive. Behind the bonnet, there's some scars, there's some things we need to address or prevent. And I love having those conversations, especially when they're successful, because it's a new environment for them. Maybe they haven't been as successful, maybe they haven't been a serial entrepreneur yet, and they don't know how to behave in that environment. Maybe there's a minority in that environment, as we were discussing, and they need support regardless of how successful they look like. So it's a continuous job, and whenever I see them successful, I always challenge them what's next, in case they don't have any past gaps to fill. I'm always looking what's next, how do you think about this, about that. It's always a continuous job.
Absolutely. It's again this like intention or intentionality
that
Paul mentioned, where I think sometimes in the business space, like the most like antisocial behavior is written off as that's business, and that's what it is. If you want to hire people, you want to outsource, you want to reduce labor costs, and it's just like, how do you want to run your business? Being intentional with it from the start, very, very important. And I think, like you said, even when things are successful, even more so important, maybe so. We have a question in the front here.
Yeah, first of all, I really wanted to thank you to like talking about this impact washing and like looking at what people do instead of what people say, and like WeWork or Theranos, I think are just great examples of like companies wanting to change the world and not doing what they were intending to do. My question is about sort of non-impact VC, which seems to be the majority of VC, where oddly enough, but like where it's weird that we went through, say, the crypto hype cycle, where a large amount of money was, you might as well just lit it on fire, and we did not learn the lesson, right? It seems as if we did not learn the lesson, and it's striking that sort of tech for impact investments did well, while these like wild investments went bust. And yet we don't seem to have, and traditional investors, for the lack of a better word, have not learned the lesson. How do you think that kind of bridge can be divided? Because let's face it, the vast majority of capital is still locked in non-impact VCs.
Interesting one. I can jump first after you guys. So first of all, I'll give you a very simple example, right? How easy it is for us to change our behavior and recycle more and pay more attention to the environment as a simple human being. It's not that easy. We have to change behaviors for that. So it's not that sexy either, looking like towards us as individual. So when you compare something that looks super sexy because overnight there's lots of retail investors that feel FOMO and jump on the crypto wave. Obviously, without even asking, someone, maybe, you would have someone here on stage talking about crypto in a nice narrative that you would believe in, and then you would follow through and just put 10, put 20, you see it's growing, so it becomes a nice bubble to join, right? Some of them will make money, some of them will not. Whereas here, the bubble is the earth. The bubble is the most precious thing we have to conserve, and that doesn't have a price tag on it, and it doesn't have anything, but in the end, it's not that cool to brand either, because it's if you don't do it, it's detrimental. If you didn't do the crypto investment, then you remain the same. If you did it, maybe you were poorer or richer. But here, there's no other variable. It's a clock ticking towards an unimaginable destination that we don't want to be there, and it's hard to brand that out there. That's my opinion on it.
Yeah, what I hear in that is these hype assets. I think crypto is a great, horrible example of a hype asset. And so I think, at an individual level, we should all be asking ourselves and asking our communities, like, is this a hype asset? If it's, I think most innovation, like most of this impact or things that have real potential to solve real problems are actually like not sexy. And I think we should actually be seeking these unsexy opportunities. I think that's what real growth is. Hardware, is not that sexy, but I think it's much more necessary. I think, what I would like to say to classic VCs, if anyone's listening, is like recognize the positional power you have in the room. I think crypto is a great example, and you said it as well. You've got a bunch of uninformed people who are not investors, they don't know that world, who hear the very tantalizing promise that for just a few dollars, you too can be a part of something huge and it can make you rich. And like that is a very dangerous but very compelling narrative, and there's a responsibility of people who know better to say so and say so loudly and often, and to recognize that when you point a signal and say, ooh, when the big Silicon Valley investors say, here's where I'm putting my money, that people are listening. And so investors should be more intentional about where they are directing public attention as much as they pay attention to where they're directing their capital.
Yeah, so my experience is the venture capital sector is actually quite varied. There's very different setups and approaches within that, and I think the ones who I've noticed taking impact more seriously are the ones that are they're a bit more like a franchise. They're like established names. They're sort of and they recognise things like succession planning, and like they recognise that their reputation is like sort of one of the things their strongest assets rather than their capital and things like that. It's the ones you've heard of, the big ones, and they're a very important part of the venture capital business. They're less prone to some of the hype stuff, although I think they're people assume they are, but when you look at the stats, they are slightly less prone to that. The big bit of the venture capital industry is the bit that you where you haven't heard of the firm, and they probably only run like one fund or maybe two, and then they sort of disappear again. That bit, I think, will slowly die out, if I'm honest, and you'll get. I think there will be new impact franchises that join the big firms, because I think impact is the growth sort of part of venture capital. But I think the bit that isn't taking this stuff seriously is the bit that like does fall for all the hype cycles, does one or two funds, then like disappears again. And I think Darwin's law means that eventually we'll end up in a better situation. So that's my positive take on it.
Absolutely. So we have time for one more question, and we'll close out with quick lightning round rapid fire Q&A at the end.
Cool. Hi, everybody. Thanks very much for the panel. My name is Matt. I run an impact venture in the mobile and data space. So Remus might come find you if you have some spare time. But in one of the previous sessions, there was a comment around like the need to re-engineer capitalism. And that particularly resonated with me in the context of business models. So one of the frustrations I've had is that when I have spoken to impact investors in the past, we have a very clear impact mission. Our impact scales with financial success. But when I've explained the business model that we are trying to pioneer, which for us also needs to be impactful and really respectful of the way in which we're trying to cater to our end users, etc., because it was novel and foreign, there was a lot of like, not sure if that makes sense. And then if you said something like, oh, we'll just do advertising, they're like, great. And so I'm wondering if you have seen in this kind of space a growing openness to different types of business models and to kind of, business models that, to your point, Linda, like respect the impact that the organization is in its mission trying to achieve, or whether that still is an area that needs a bit more kind of focus separate to obviously like the bottom line impact that a business has on its tagline.
I think I heard that question. Sorry, I was a little loud. Is like, where is the appetite for innovative business models? Yeah. Is that it? And specifically in impact?
Yeah.
Ooh, and I think we need more. I do think there's perhaps some reticence. You're absolutely right. If you say we're going to sell data, we're going to sell B2B, and we're going to make our money off of ads, people are like, excellent. I've seen how that works. I know exactly how to measure it. I know what the benchmarks are. I think that's a real. People get anchored to that. So I think there is a need for innovation in business models. And I do think that's going to take some time, and I think it's tricky. So I'd love to hear more about how you're thinking about that, and what you're doing in terms of like selling that story. How to I think you do have to show some evidence. What does that user growth look like? What is that retention? Is it actually sustainable? But I think there is a real need for innovation in that sphere.
Yeah, my perspective, I love in a simple way. Business model innovation is probably one of the simplest levers of adapting, pivoting, and growth. So yeah, I really enjoyed it. I did it myself as a founder. I do believe there's more space to be done more often by founders, and more space from traditional VCs to accept it. And I think the challenge there that you might encounter is that VCs, because of the amount of deals they see, because of the pressure they have with the funds, etc., all of these ingredients they operate their businesses on, they start seeing in patterns, and they start filtering out deals in certain ways. So obviously, when you come with the SaaS model, they're the happiest because they know how to do the modeling till the IPO. If you come with something else, it's more thinking to do, higher the risk. They haven't seen something like that. So it's also normal for them. So I think it stands more with you to try to cross-reference this model in maybe other industries, to just show some proof of traction in that type of approach that you're proposing. And they should be open enough to embrace that.
Yeah, and find the investor who wants to do that work.
Yeah, we did something like that, and we were happy. They're still struggling because it's a new model, but we accept that, and we're 100% behind the founder.
Yeah, I think it's a bit of a side effect of venture capital scaling. So, there's the venture capital sector, for want of a better word, is 4 times bigger now than it was 10 years ago. So it's become more of a machine. And so it looks for pattern recognition because there's like more people who sort of have learned it from other people, if you see what I mean. And so it becomes more of a like cookie cutter, to be honest, in the main. But I think that the great like investors who spot something that nobody else has spotted are still there, but there may be a smaller proportion of the VC world or the investor world because the whole world has got bigger and has got more sort of mature systems that mean it just looks for particular things in the majority of cases, which isn't a great thing, I admit, but I think I get your frustration with it.
Absolutely. Thank you a lot for these questions. We're going to do a final lightning round, give you one question and respond in one word or maybe one sentence if necessary. Who wants to volunteer first? I'm going to ask before I ask the question, somebody signed up to go first. Or I'm going to choose somebody.
I'll start first.
Thank you, Linda. What's your hottest take or your most controversial opinion?
Hottest take is that the world needs more than B2B SaaS.
Beautiful.
We'll have 2 more prime ministers by this time next year.
Hottest take that a corporate can be an impact investor if they look with the right lenses.
Beautiful. If you had to invest all of your money or time or energy into one emerging tech industry or sector, what would it be? Remus, you first.
Obviously, everyone would be nowadays with Gen AI and impact and sustainability. But there's a particular technology that I love. It's extended reality. I would like to put my bet on it because I want to influence the way it's going to be used in the future for our kids, for our grandkids. I think it's such a dangerous technology if you don't put it in the right hands. More dangerous than social media has been with the side effects that no one knew about. So yeah, that would be one.
Paul, in one word or sentence?
Rewilding.
Okay, maybe a sentence?
I think like helping nature restore itself is going to be a massive thing over the next 20 years.
Yeah, I want more of that. But I'm gonna say like food supply as connected to climate change.
Absolutely. And last one, any resources or tools you recommend for people in the audience who might value from?
Ask a lot of questions, talk to investors, talk to founders, ask them where they get their money from. I'll start there.
Well, so I mean, according to founders who talk to me, it is actually like ChatGPT is actually is a better way than you might imagine of learning about and understanding impact investing and impact VC. So yeah, I'll try it.
I will stay to books. And then there's an interesting book written by a B2B entrepreneur, like tech entrepreneur trying to sell to corporates, called Lean B2B. They're taking the entire Lean methodology and transferring it into how to plug your proof of concept, your MVP, whatever you have as an innovation into a corporate. It's such a different type of selling, of navigating, etc. It's so crucial for founders, especially at the first venture.
Absolutely. And a round of applause for our panel. Thank you.